Did we lose Jivraj?
No, I'm at the. Yeah. Great. I think we're live. Thank you so much again for everybody to join in. This is our third session for the day, and it's an absolutely spectacular one as we going to discuss the angel VC relation. So as the summit has progressed, we've heard all about angel investments in depth, and now we want to go to the other side and understand from the VC institutional investors as to how they look at angel investments. We're joined by a super panel from the ecosystem. We have with us Tarun Davda he's the managing director of Matrix Partners in India. We have with us Mukul Arora. He's one of the managing partners at Elevation Capital, previously SAF Partners. And we have with us Neha Singh, the co-founder of Traction, who's also an angel investor herself. Neha will be acting as the moderator and will keep pitching in to the multiple points mentioned by the panel. So I'll now leave it up to you and hand it over to Neha for the rest of the panel. Thank you so much.
Thanks, Yuvraj, for that quick for the introduction. Glad to have Tarun and Mukul along. Great to have you guys for this session. So just to summarize, the session is about VC and angel relationship. And how the two sort of are can work together, or you've seen them work together. So let me start with the basic thing, which is based on sort of your personal experience. How have you sort of worked with angels in the past? Is there some deals that you might have got through them, or you might have got angels in the subsequent rounds, which turned out to be sort of valuable for any of the portfolio companies? Anything that you've seen based on personal experience? What has the things that you've liked?
Yeah, I'm happy to get started. Mukul, unless you want to go first, please go ahead.
Go ahead, Tarun.
Yeah, okay. Thank you, Neha, and thank you everyone who's sort of been part of the organizing committee for this. Great to be a part of this. I know I'm replacing Anand, who's down with COVID. So wishing a speedy recovery. Just from our perspective, on the angel VC relationship, it's actually become even more critical, at least for me and for us as a fund over time. And I'll give you an example, right? When I started investing, this was about 9-10 years ago. There used to be some deals we saw that had, some angel investors on the cap table. But we would never actively make an effort to sort of bring in other high quality angels onto the cap table, right? And then I think what started happening is in some of the companies, we started noticing something very interesting, which is, there would be some important customer win that the founder would tell us about. There would be some, interesting hire that the founder would tell us about. And I think that's when it started becoming clear to us that, listen, it takes a village to build these startups. And while, the individual sort of VCs will do whatever they can to help, build the company with intros, with network, with hiring, stuff like that, nothing can replace the power of the network, right? And so I think what we've started doing, at least at Matrix, is I think two things. One is in pretty much every company that we are investing in, we are actually actively carving out a portion of the overall round to say, hey, here, whatever that may be, and let's assume when we're investing 5 million, we're carving out like 500K or few hundred K and saying, hey, here is what we would want to keep aside to bring on, high quality, high impact angels, right? And then we work closely with the founders to make specific introductions to these angels who can help grow the company, and we've seen that has been extremely helpful, right? And so it's never a force. Yeah, hi, can you hear me?
Actually, I can hear Tarun well.
Okay, sorry.
Yeah, so I think it's been very helpful. Obviously, eventually it comes down to the chemistry between the founder and these angels, and we don't kind of force fit anything anywhere, but it's a double opt-in, right? If the founder likes the what the angel brings to the table and vice versa. The other more interesting thing, Neha and Mukul, that we started seeing is angels are starting to, both founders and VCs are seeing that when putting angels who are actually very good at certain specific things, right? It could be introductions to potential clients, it could be hiring, it could be design help, it could be a bunch of things. And when they are sort of starting to work with the VC, obviously the relationship starts becoming even more strong. And over time, those angels are now actually introducing us to companies in their portfolio saying, hey, I know you did this investment. I have a founder who reminds me a lot like this other person. and they're building something very interesting. Would you like to participate? Right. And so it's becoming a much more synergistic relationship. And I would say, we did about 20 odd investments last year. I would say at least 5 to 7 of them actually came through these kind of angel introductions to us. And so we're starting to see that flywheel kind of working, where there is a certain level of comfort that both sides derive from each other.
I think, Neha, the only thing I would add on the second point which Tarun mentioned, which is introductions coming from angels. So what's also happening, especially in last 2 3 years, is that companies are getting funded much much earlier in their cycle. So now, like an angel check in a lot of cases would happen when the founder has not even put in their papers, and VC would come in when the product is not even live. Sometimes even the company is not registered. So earlier, typically we would invest once the product is live, or at least once the company is formed. We would typically even discover most companies on Traction or Let's Venture or those kind of channels before any other source. But now investors are coming in much earlier, and therefore angel intros become all the more important, because you wouldn't even know, hey, there is this person in XYZ company who's leaving and planning to start, but angels would be there, they would know, and they would make those introductions. So I think from that perspective also, that relationship is becoming much much more important now.
Right. No, that's great to see. Like, I think like 10 years back, this used to happen in Bay Area. Like, Angels used to be this network, and, people used to maintain the relationship very closely and get a lot of deals. And I think Indian ecosystem has evolved, so much now. There are repeat founders or people who have worked in, in startups who are now starting. So that whole ecosystem, I think it's also fueling, this whole network based. So that's great. Taking a detour, how have you sort of seen, sort of the whole angel investment, the asset class, or the category sort of evolve in the last 10 years? Like a couple of the things that for instance stand out to me. One is basically it has become much more broad based. So earlier, you used to have like a few HNIs or probably a few founders who would be angel investors, but right now you have a lot of VPs or of senior management of other companies who are also investing. So that is one thing. And obviously the ticket size, earlier it used to be much smaller. Now you also have angels who are doing like 100K. So how have you sort of seen just angels from an external perspective, this whole sort of asset class or this whole category evolve over the last decade?
Yeah.
So
Mukul, you want to go first on this one?
Sure, Tarun. So at least one big trend which I have seen, and Neha, you touched upon it, is that now there are a lot more angels, and also diversity of checks. And what that means is that in some ways there is oversupply of capital and angels versus startups, especially high quality startups. And by the way, this is true not just for angels, it's true across rounds. You look at a seed round, look at seed funds, you look at VC funds, there is more capital than there are high quality companies. And I think therefore it's more important than ever for angels to have a very, very clear brand name or positioning or value prop. And again, this applies not just to angels, but even to VCs. That, hey, beyond capital, now capital is a commodity. So beyond capital, what else are you bringing? And like Tarun mentioned, couple of areas. Can you bring some functional expertise? Can you help me with tech, marketing, product, etc.? Or do you have deep networks? So can you connect me to customers, investors, etc.? So I think that's the biggest change which has happened pretty much across the value chain. That capital by itself is now a commodity, and therefore you need to have a very, very clear positioning or value prop, because of which you will be able to get on the best cap tables. So that's the biggest change, at least I've seen in the last few years.
That's
Yeah.
interesting.
The other thing, and I think it's all a very good point from Mukul on the sort of commoditization of capital at every stage. I would just add one thing. For angels, I think India has not been the most favorable exit climate, right? And I think for a lot of people, seeing the entire cycle play out, right, is very important, because that's what sort of brings money back into the companies, and that's how we started recycling. And I think there is a lot of maturity that we are seeing over here, where there are angels who have come in at the angel pre-series A seed stage. They've stayed on till Series B, Series C, Series D, depending on whatever. And there are now actual mature conversations that are happening, saying, hey, I need to bring on this investor, here's an ownership requirement that they come in with. I've given you a 5x, 10x, 20x, whatever that number may be in the last 2 3 years. And angels are collaboratively working with these founders to say, hey, you know what, this is great. Nothing else would have given me a 10x return in the last 2 years or 3 years. Why don't I take some chips off the table, because I can potentially help another founder at that early stage, and it may work, it may not work, but there is another 10x potential, and that capital is coming back into the ecosystem as such, right? And so let's assume I take out $100,000 from some company that has done well. I can write 10 more $10,000 checks each, right? And I think that really helps. So I think that's the other important part that I've seen, where earlier there used to be a lot of tussle between founders and angels, because such few companies used to work, such few companies used to have liquid stock, so to speak, that the ones that did, like, there was always a tussle to get people to exit when they need to, right? Or it was the reverse, where, hey, it's been 5 years, please find me an exit, right? How long can I wait? And so I think it's also becoming a lot more liquid, at every stage. And I think overall that just goes to show the health of the ecosystem. And in my mind, I've seen a lot of very good examples of partnership approach to getting that capital to rotate.
Yeah. No, that's correct. Like, I think right now funds are also becoming sort of open to giving, angels exit if required. Obviously, it is a discretion of the angels how long do they want to do that. But I think just, funds are becoming open to that along with the rounds that is happening.
Yes. No, it goes back to the point Mukul made, right, about oversupply of capital. And so when that happens, see, earlier when companies were starved of capital, unless the company was profitable or was very clearly overfunded, it was almost always like every money should first go into the company, right? Today, you pretty much know that, listen, if the company keeps executing, at every stage there will be enough capital. And so I think that has changed that dynamic.
Right. No, that is interesting. Yeah. Just moving on, to the next point, which is, we briefly covered it earlier, which is the ways in which, you interact with the angels. And you mentioned about, for instance, you mentioning about that you get angels along. Do you see, going forward, like in the next couple of years, as it is going to become more active, do you see sort of funds having more structured programs? So, for instance, there are scout programs which funds have. Now, earlier it used to be in Bay Area. Again, now funds in India have it, which is they've set aside a pool of capital which angels can call as needed. Or things like you were mentioning, having carving out a pool of capital along to invest along with the rounds. Any of the things that you would see structured way of funds working with angels, going forward in the coming years to come?
So you mentioned Scout, and a couple of our sort of peer VCs have that, and I have a little bit of a mixed view on that, because I think eventually, if the money, it comes down to the color of money, right? And if the money is, that it's coming from a particular institutionalized backing, I think it has both its positives and negatives, right? Positives are, that okay, you have access, and when you're ready to raise the next round, you'll probably get an early look, and so on and so forth. But there is also a real, signal where, if for whatever reason things are not working out, or the fund whose Scout is put in the money is not participating, I do think there is a little bit of a drag. I don't think it's as much as it used to be, but I do think there is definitely some drag where the founder has some explaining to do, saying, hey, if things are so good, why isn't this other fund jumping in, right? And so I'm still not convinced that that's it's definitely got its pros and cons. On the other hand, I think there are a lot of angels that are having more of lightweight, informal relationships with QVCs, right? And there's a bunch of them that we all know, where they'll be very friendly with the guys at Elevation, with us, with Excel, with Lightspeed, bunch of other funds, and they'll say, hey, you know what? I know this is something that Elevation would like, because this is a strong thesis they have in this space. Or, hey, I know Matrix will do this because you have a bunch of investments in this space. We know it's working. You've got good knowledge through those. So I think at least the path we have chosen so far is to keep a little bit more of an informal relationship with a bunch of high quality angels that we like to work with. And it's symbiotic, right? When we're investing, we try to get them into as many companies as we can, and vice versa. And I think that works out really well. I'll give you an example, right? And in fact, the other thing that is happening is we're having these super angels come in, right? Just like Silicon Valley and China had. Today, I mean, rounds are being constructed by these angels. They are deciding how much allocation each fund will get. They are deciding, when the founder will go and talk to which fund. They are deciding, who gets the IM on T-1 and who gets it on T and who gets it on T+2, right? And so I actually, we've been fortunate in a couple of cases, in fact, very recently, where there are certain, founders who are sort of very well known, very well respected, we've invested in. They are now like early angels in some of these companies. Now they are, I mean, the founder who's doing it for the first time is relying on the experience of these super angels to say, hey, how should I go about it? When should I talk? And we've been fortunate where because we have the relationship, we've been able to get into those deals earlier. And so I do think it is. It is becoming a lot more structured. But every fund has its own style, and I don't think there's any right style or wrong style. It just comes down to what you're comfortable with. Yeah, I would just say that.
Right.
Honestly, not much to add on this one. I think Tarun has covered it comprehensively. Even our approach at Elevation has been to keep it more informal and keep it a two-way relationship. Where again, similar to what Tarun mentioned, there will be situations where angels will introduce us to companies, and there will be situations where we will feel that hey, we are investing in this company, and these three people could add a lot of value. So it could be a win-win, and we would make the introduction. But we have also decided to keep it more informal, which actually solves for the best interest of the startup versus
Right.
having angels who have some sort of vested interest.
Right. No, that makes sense actually, structured way, and also sort of angels have become more savvier. I think general founders have become savvier, angels have become savvier. That's good to hear.
Other than VCs, everyone's becoming savvy.
Yeah, so earlier, I remember this was way back, when I was a VC, and we had to actually explain what is VC to people. So one of our, roles was basically to basically get the deal sourcing part, and then you literally had to explain that, okay, what, this is equity, this is how it is done, and people would never have heard about all these funds. And obviously, this generation, knows about funds, knows about who you should talk to, who within the fund you should talk to for a particular sector of deal. So obviously, I think it has evolved a lot.
I'll tell you one more thing, Neha, and I think this is also an important thing that has happened, and I think we've been guilty of it, right, in the past. There was a time where all of us used to draw these artificial lines in the sand on a particular ownership level. And we'd say, hey, you know what? I'm not coming in until I don't get, whatever, 20%, 25%. And obviously, those days are gone. I don't remember the last time we saw 20% in companies that we've invested in. But over time, I think we all have also, and we used to tell founders, saying, hey, you know what, if you want to get these angels, great, but it's coming out from, your dilution. Our whatever post money is fixed. Yeah. And I think over time, everybody has reached the answer to say, hey, you know what, it's not about your individual slice of the pie. Let's do what's right for the company. If these three angels are going to have like a needle moving impact on the company and are going to help this company grow, you know what, whether you own 18% or 19% or 20%, you're going to be really happy, right? And you're going to make enough money, and it's in the right interest of the company. And so I think that's been an important evolution also, where I don't think people are taking very hard positions and walking away from deals saying I'm not, because again, right, there was always an issue where we just didn't have enough successes. Now that across the board you're seeing a lot more, there's a lot more liquidity, there's a lot more sort of velocity of sort of fundraising has gone up. I think the ecosystem has evolved to say, hey, you know what, let's just do whatever's right for the company. Let's not take too many hard positions. And I think that's been a big change that has happened.
Right. No, that is correct. Earlier, there used to be like unicorn would be like once or twice in a year. Right now, you have, like a dozen unicorns already, and decacons. Now you're looking at multiple decacons. So right now, I think just the upper cap has gone higher. So then you're more flexible about when you get in, if it is a rocket ship.
Correct.
That is. Moving to the next question, one of the questions is more if you look at it from a third person, how do you see the role of angels evolve? So one of the things, for instance, earlier there used to be a lot of rounds which was just done by angels. Right now, if you see, there are hardly any rounds which are just done by angels, and then you have seed funds who have become super active, and there are the number of seed funds would have also increased a lot in the early stage. So it has become sort of much more competitive, so as to say, someone who's doing sort of angel investing as such. So So how do you see? The other thing that is also happening is, some of the proven teams, the funds are actually writing much earlier checks, in there, like a large seed check. So how do you see sort of, would Angel continue to have access? How do you see, that sort of evolve over time, or is it just a blip that happens?
So, Neha, I would share a couple of thoughts on that. I think one is, as you rightly said, it is much more competitive. And therefore, if I'm an early angel starting out, I would look at two sort of different paths. And it's not either or, it could be a combination, but there are two directions. One, do I feel that, hey, I have a strong spike in a certain area? And like I was saying before, therefore, I can build a very strong brand. And there are multiple angels who we know who have built strong brands, again, either on functional expertise or networks, or just their brand, like having them on your cap table gives some sort of validation. So do you feel and are you willing to put in that effort to build your brand? Or the second option is that if you are not sort of going to go the whole hog, you are not willing to invest that much time, then ideally you should try and be part of a syndicate. So that syndicate could be a formal one, could be an informal one. So there are enough like IIT syndicates, enough university alum syndicates, enough ex-founder syndicates. So can you be part of those, or even be on some of these online platforms, so that you have at least better access to deals, and you also have some other signals that, hey, who else is investing in this company, and have I heard those names? Do they know about this space? And use some of those signals to at least get a soft start to start investing in these companies. So I think one of those two paths have to be picked. If someone is doing it part time, also doing just one-off deal which they hear through someone, then I think chances of success are very, very low. Anyways, it's a tough industry. We are all sort of hoping to catch outliers. So I think one of those two approaches has to be taken: either work on building a very strong brand or be a part of syndicate. The other thing I would say is, like Tarun mentioned, for VCs, we are much more flexible in terms of ownership. I think angels have to also change that lens. I think it's already changing, where there used to be a time when there would be like a 1 crore round for 10% of the company in early days. That in highest quality companies will not happen anymore. So don't, like, if you are getting 10% for a crore versus somewhere else 1% for a crore, maybe the second one is a better investment. So don't worry about day one ownership, but worry more about, like, hey, is it the right team? Is it the right company? Am I going in with the right set of investors or not? So I think angels will also have to change that mindset of ownership and try to get on the right rocket ships.
Got it. Got it. No, that makes sense. Yeah. Actually, right now you're also having sort of, earlier angels used to be like in the first round, but right now, even in like series, A, B, subsequently, you're typically having angels, participate. Like even in Traction, for instance, we got Mr. Nandani Lekni, along, after institutional round, Amit Singhal after our institutional round. So, and obviously they have been sort of super, super valuable in the journey. So I think that I see more and more companies also do that, which is, get in few angels. So angels are lesser sensitive to, I think, the valuation at which they're probably getting in also, and probably the ownership.
Absolutely.
Yeah. Now, the
Makes
only other
sense.
thing I'll add is, see, what's happening is we're definitely seeing sort of, fund pretty much everybody across the value chain starting to go early. As, exit valuations go high, as there's more capital available in the ecosystem, capital will start rushing in, and it will always try and find the sort of earliest stage that it can enter, right? And so there was a time where, we would say, hey, you know what, this is too early for us. I don't think that
Right.
paradigm exists anymore, right? Because the cost of waiting now is so high that between company that raises a seed round at a 10 million valuation today and in 3 months is raising a Series A at 80 to 100 million. I mean, the risk reward doesn't make it's always better to go earlier, right? And so it's very rare that we actually look at a company, if we like the team, we like what they're doing. I can't remember the last 5 years where we said, "Hey, let's wait and see how this tracks." Like the cost of, I mean, whenever we've done that, I mean, it's been a massive mistake on our part. So one is everybody's going earlier now. So the traditional, hey, this is an angel round, and this is a seed round where the micro VCs or the seed funds will do it, and then it will come to an elevation or a matrix for a Series A. All those lines are blurring, right? But it's becoming important, and everybody's recognizing that, listen, you still need those each of those players in the company, right? Because what, say, a Nandan can do for you, and institutional investor may not be able to do, right? And so I think the mutual sort of understanding and respect that, hey, you know what, all these constituents are important, and each one has a role to play. And the founder also does need unbiased advice, right? There are times where an investor and a founder may be on different sides of the table. Most of the times, as equity investors, as early investors, we're on the same side. But there are cases where our interests and their interests may not 100% align. And having somebody who's been through the journey a few times, or is less biased than we are, or not biased at all, is hugely helpful, right, in getting the company to the right decision. So I think I do think that is happening for sure. The other thing is, I'll just underline what Mukul said. Um, I've had a few friends who approached me and said, hey, shall I join this angel syndicate, or somebody in my city is doing this. And my advice to all of them is, listen, unlike in most other instruments, early stage startup as an asset class, it's highly power law driven. Now, by definition, if the best founders and the best teams are not going to those syndicates, you are seeing a pool which, by definition, has very, very low chances of success. To Mukul's point. Now, even if you're a angel in that syndicate and you're investing in 10 startups, the chance of success is not very high, right? And so, at least my advice to them is, listen, join a syndicate that has got some track record. Join a syndicate that is viewed positively by founders, where they will want to go and get some money from them as part of a round that is happening. And third is, just make sure that you're not being too selective, because at that earlier stage you need to do enough volume to catch the successes, right? And to Mukul's point, even if you own 1%, at least what this is a like I said, we all used to be the, hey, I need 15%, hey, I need 20%. The question we're asking is, do I want 0% of this company, or do I want some percent?
Right.
Right? And the answer almost always is, listen, I want to own some percentage of this company. It may not be ideal, but I'd rather be in this company than not. And so I think that's the same attitude like everybody needs to take.
Got it. Now that's also a good segue into one of the questions, as some of the audience is our angel investor. So some advice that you have for angel investor, for instance, how much pool should they set aside, or in terms of someone who is probably looking to sort of ramp up their angel investment as an investor. Essentially one of the things that I say, for instance, invest only the money that you are willing to write off, and don't count on that returning. So any tips that you have for people who are sort of jumping in terms of how should they see about it, and things that they should do?
So
yeah, go ahead.
I'll share one thought more around exit versus investment. We've spent, I think, some time on investment, but on the exit part, right? I think we touched upon this point that in subsequent rounds, when VCs are coming in, oftentimes they will ask founders to see if they can get some exits from angels. And in general, what I have seen is, even as VCs, for us, the biggest mistakes are selling too early. If you have actually invested in a high quality company, and there are oftentimes where actually we'll be on the other side, we'll be the VC saying, hey, let's get some of your angels to sell. But if you have actually invested in a high quality company, you feel like it's onto something big, founders are shaping up well, the cap table is shaping up well, high quality investors are investing, don't sell. I think, and legally you are not expected to sell. If you have made a 10x on that investment, again, doesn't mean morally you are obligated to sell. And the tricky thing is, like Tarun, you were saying, if in that 10x, sometimes you are tempted that, hey, let me take half the money off the table, I can do 5 more investments with that. But let's say that company goes 5x from there. Actually, from those incremental 5 investments, you will have to find 5 more 10x to sort of replace for that loss. So just hold your ground. And I know I'm shooting myself in the foot here, because we'll be on the other side trying to buy from you, but hold your ground if you are actually in a rocket ship, because there are so few of these in our industry, that if you are on that, just be there for 5, 10, 15, 20 years. And the good part of being an angel is there are no hard timelines. You don't need to return money to anyone else. It's your own capital. So just stay put, take as little liquidity as needed for whatever purposes. Otherwise, don't get off a rocket ship. So that's the most important thing I would share.
Got it. Yeah, that is one of the, I'll also just take up one of the questions which have come in. So, how much do VCs care about the number of angels on the cap table? So this is probably the VC's perspective on there. What do VCs care about? How many sort of angels are there on the cap table? What's the views on that?
Yeah, for us, I think it's less about the number of angels. Honestly, it's always been about, hey, are these sort of adding value to the founder in any way or to the company in any way? That's generally the most important question that we ask. And second is the arrangement that you have from a paperwork perspective, does that allow the company to move quickly when they need to, right? So if you're closing a new financing round, close within 30 days, whatever it is. Like if you need to go to 20 people for signatures, and all these are wealthy, successful people in their own right. Many of them have their own business and travels and all other things that keep coming out. We've had cases where rounds have actually got significantly delayed as a result, right? And so at least what we try to do is we have a simple deed of adherence. We say, hey, sign on to this. All your rights are protected. The only time you will need to sign on a document is if your rights are getting adversely impacted. But otherwise, generally, you don't need to sign every new version of a shareholders agreement, or one representative angel amongst all of you needs to sign, right? And so I think that's what we generally honestly care for. It's less about the number. I mean, if it's 5 or 10 or 15, it doesn't matter. Now, if it's 50, yeah, then you have a question to ask yourself whether long term that's sustainable or not. But generally, we don't see that as much.
Got it. Got it. No, that makes sense to basically structure the paperwork accordingly. Yeah. Another
Yeah.
question that has come in, so I'll just read that out. A VC might add angels in a round, but most angels won't want VC in a round as they would lose their upside. Would love to hear a perspective on that. So I guess the question means, if you're in the early stage, you're an angel and you get a deal to a fund, and the fund says, I want to invest like $1 million or like $2 million, and the valuation goes up. Then, have you seen any of those, and what should angels sort of do in those cases?
See, again, if I put myself in an angel investor shoes and I feel like there is a high quality company, and me or my syndicate can give them enough capital to get to the next logical milestone. So let's say they need 500K to build out a product, get some early traction, and me and my syndicate can give that amount of capital. Don't take it to VCs. You should just do it on your own, solve for your ownership at that stage, and versus sort of trying to show it to VCs, because like Neha, you said, VCs will end up investing a much larger amount, and actually it might be a 1.5 million round where all angels get only 100K, even though you could have invested more because of a VC's ownership threshold. But having said that, two scenarios. One, let's say VCs are already talking to them and they are investing, then don't hold back because of ownership, like I said earlier. And second, if genuinely in interest of the company you feel that, hey, they need this 500K to get to this next milestone, I can only invest 50K, 100K, then you should definitely take it to VCs. And the primary goal has to be that solve for success of the startup. If it becomes successful, you will make money, founders will make money, investors will make money. So then don't get greedy that let me give them 100K, something will happen. Then solve for probability of success, either through more angels or through a VC, and make sure they get adequate capital. So that's how I would think about it.
Got it.
Yeah. I'll just add, I'm more in the second camp actually, and I'll tell you why, because we've seen this play out multiple times. See, it goes back to what we discussed earlier, right? Like if this is a team that you have high conviction in, and getting a institutional investor helps increase the odds of success, right? As an angel, even though your ownership may come down, your the valuation in the round may go up a little bit or whatever it is, I don't think anyone is investing for the upside in one round, right? You don't ever make money because, hey, my seed company raised a Series A. Generally, there's no exits in Series A. I mean, this is the business of finding 10 baggers, 20 baggers, 50 baggers, right? And so I think if the odds of success of the company are going up, I think there is enough data, by the way. I'm happy to share a link offline where somebody had done this analysis to say what are the odds of success of a company to reach a Series D, which is generally 500 million and above valuation, when there was a tier one institutional investor on the cap table at Series A or seed. And I think the probability was significantly higher. So I think as an angel, you should be doing the exact opposite. If you are able to find institutional, top tier investor to come and invest alongside you at seed or whatever it is, you're doing yourself a favor, even if you are cutting back, because your chance of success is going to go up. Number one, and number two, your downside is protected. Like if a tier one is, or any institutional capital is coming in, I mean, hopefully they've set aside sufficient capital that even if things go sideways for some time, they will support the company for some more time for them to find sort of that product market fit. Whereas as an angel pool alone, you may not have been able to sustain that, right, for a very long period of time. And so I actually think it's limiting downside, but it's also potentially increasing the chance of upside significantly.
Right, right. No, that makes perfect sense actually. There's another question from Tanmay who has come in. How can a non-operator angel provide value in early stage rounds where multiple VC, micro VCs, angel funds, and angel networks also play, especially in a market when there's a lot of value that investors provide that has been fairly standardized? So I think this is from the angels, what for a non-operator, what type of value, for instance, that they can think about providing. Like so I'll just add to that, one of the ways in which, I have seen, for instance, like as you were just alluding to, which is just having network with a few late stage funds whom you can actually give sort of good curated introductions, which is beneficial for the company or for the fund. That's one of the ways in which I've seen sort of angels add value. But please add more things that the angels can do in this.
Yeah. I think it'll come down to two words in my mind, Neha. It's hustle and empathy. Everybody has this. You don't need to be an operator to have this. You don't need to be somebody with a lot of connections in the industry to have this. And I'll give you an example. So in one of our companies, there was this angel who was a Singapore-based like banker. Like he had nothing to do with India. He had pretty much no knowledge of startups or the domain in which that startup was operating. And when I asked the founder, saying, "Hey, which angel are you sort of most in touch with?" He gave me the name of this guy, and I was like, "Okay, but what do you get from him?" He's like, "He picks up my call." Right? And sometimes the bar is just so low, right? Because everybody is busy, everybody has a lot of stuff to do, right? And I said, "Okay, but tell me more. What do you mean by he picks up my call?" He said, "Listen, even if he doesn't have the answer, he hustles enough. He pings 20 people he knows in India, and via, I will get something back from him. It may not always be exactly what I was looking for, but 5 out of 10 times he will find me a better answer than I would have reached by myself." And so I think if sometimes the bar is just that low. Yeah, I mean, I don't think you need to be this design guru or product guru or tech guru to or have like 20 potential customer introductions you can do. I mean, there are multiple ways in which you can help founders without being intrusive, right? Obviously, it has to be more on a pull model than a push model. But if the founder is reaching out, just be available and just try and help to the best extent you can.
Right. No, that is actually, yeah, sorry, Mukul, go
No,
on.
please go ahead, Neha.
Yeah. Now, I was saying that's actually, very valuable. So just to give an example, for instance, even like friends that right? Like, for instance, Sachin Bini had come in an initial round. Sahil Barua from, Delivery founder had come in the initial round. So typically these are people in the network, but, how many times will you bother them? So if you get them onto the cap table, then, you have sort of more sort of leeway to at least ping them, say, twice in a year. And, you also feel that, you're not sort of taking a lot of their mind share without any context. So I think that is well said, that you also get a ticket, like by getting an angel you also get a ticket to have a few meetings with them, like even once a year with like Mr. Nandan is like
Yeah.
incredibly valuable.
Correct.
Actually, the only thing I was gonna add is that even this quote unquote operator uh, should be defined very broadly. So operator doesn't have to be someone who is working in the internet ecosystem. So let's say you are working in traditional financial services industry, you can bring so much value to startups in thinking through the debt side of things. That hey, how to solve for debt, what are the various sources of debt, can you make a few connections to help with that. Similarly, let's say you are running a traditional business, again there are a lot of learnings from there. Let's say in terms of managing blue collar workforce, which you could bring to an ops heavy business. So also define it very broadly, and sometimes it's very case by case. The answer will come more inside out, that hey, what have I been doing, what are few things which I'm good at, which a young founder will find valuable. So it doesn't have to be from tech ecosystem at all.
Got it. Makes. There's one more question. Is it better to differentiate the value proposition or just be more qualitative with the standardized value? For instance, downstream investor connects, talent recommendation. So is it, I guess it's about like being more focused, for a few things, or is it, for the angels, sort of what works better? So I guess we partially answered this initially in our discussion. So I'll just
Yeah.
skip this. I'll take the last one, which is being a founder yourself. Have you been in a situation where we asked to give a forceful exit to angels, and you were pushed from both sides? So thankfully, I guess from our VCs, we have never been asked to force the angels to sort of exit. I think everyone has been sort of fairly collaborative in that sense. I think for us, it has been. So whenever the angels, sort of require an exit, we have tried to find out in one or two situations, but most of them are sort of long term. So, in our case, that has never happened. On the other case, when I've seen some companies wherein angels are being pushed out, I think a couple of the things that I see of to angels is that, one is that don't bother the founders a lot. It's like, you don't want like an update on a monthly basis. Just let the founder basically come back. So, the angel and from the founders perspective, I think angels, as you were also mentioning, is that whenever the founders basically need the help at that time, if you're available, then that's super helpful, because you typically would be good at one or two things, and then at that time, if you're available, then that's very valuable for the founders. So I've not seen a lot of those cases, but I don't know if you have anything to add, which is angels being forced to sort of exit, either from company or from any perspective. Anything that you guys have seen.
I think it happens, Neha, and unfortunately, there are compulsions. I don't have a very good answer, honestly, because I can argue both sides, right? One is
Right.
somebody is coming in at a very high valuation. They are taking significantly more risk with a larger pool of capital. For them to justify their risk reward, they need a particular ownership. The founder will argue that, hey, you know what, I've already given you like a 20x. Why can't you take something off the table? It will help me close this round. And founders just end up spending so much time and energy convincing both sides, right? And it can get really draining. Uh, and from the angels' perspective, they'll be like, listen, 1 out of 20 things I do actually becomes this big. And the one, if I start taking my chips off the table in the 1 or 2 that work, my model doesn't work, right? And so unfortunately, there is a little bit of give and take that one needs to do. And I don't know if any extreme stand serves the company well, right? And so I think where I net out is do what's right for the company without overly compromising on your interests. And generally that means that, oh, what, the founder may say, hey, sell your entire stake, and you say, what, okay, I'm willing to help you, but you need to meet me halfway, right? And so maybe they sell a part of it to help kind of get the round. And generally I've seen, if everybody shows some compromise, generally these things work out. But the moment everybody starts taking a hard line, that's when it becomes like the founder is and the company is the one who loses the most.
Right. No, that's that. Yeah. Sorry, Mukul, go on.
Yeah, I'll add one point on this, that again, from an angel perspective, if you are, let's say, a company has 10 angels on their cap table, right? Each founder will have some sort of pecking order that, hey, these are 3-4 people who actually add a lot of value, who give me a lot of advice, and who are great for the company. They'll be the last folks that he will call to look for an exit. He doesn't want them to lower their skin in the game. He'll only call the remaining 6-7. So again, as an angel, and by the way, this is now increasingly becoming true not just for angels, but even for institutional investors. So in a company raising money at $1 billion, their seed fund will definitely get a call that, hey, can you sell some? There is more demand, and we need you guys to sell something. And again, for a seed fund, it's the same implication, that are you adding value even then at that stage? So that should be your goal, that if you are in those 3-4, most likely you will not get that call. So how do you make sure that you are important for the founder, so that he does not come after you to ask you to sell your stake?
Got it. Cool. I think that has been amazing. Just one final question for a lot of angels on the audience who want to work with Matrix Partners and Elevation. What is the one thing that they can do? How can they work with the funds, with your funds?
See, we are fairly approachable. All our email IDs are on the website. We are all on LinkedIn. So feel free to ping us anywhere. And you might not hear the same day, but you will definitely hear back from us in 2-3 days' time. That's probably the easiest.
Yeah, very very similar. Like I said, we're always one of the things that VCs do really well is talk to people all day long. So more the merrier, and we can happy to build new connections, and either somebody in our team, or sometimes the best way is to just get an intro to a founder that you backed, and that generally will because then there's some shared context of how each other function.
Right. Thanks so much, Mukul and Tarun, for the time and for the awesome session. I will hand it over to Jivraj now.
Yeah.
Thank
No,
you,
no,
Neha.
that was wonderful. I think we'll call it a conclusion. But thank you so much, Tarun, Mukul, and Neha, for being a fabulous moderator for this session. This has been absolutely wonderful, and we've gotten great insights and great feedback from the audience already. So, on behalf of Knowledge Capital, a huge thanks to all of you for spending your Saturday afternoon with us. Hope everybody's keeping safe. Thanks again.
Thank you, guys. Thank you for having us. Neha and Mukul, great chatting.
Likewise.
Likewise.
Thank